Welcome to the weekly update, where I'll go over the action in the market for the week of August 19th through the 23rd, and then we'll see how things look for the week of August 26th through the 30th. Before I get started, just a few points to go through here. Most of the analysis that I do is in the daily videos. So if you want to get things as they're happening and try to see what happens before it actually happens, the daily videos can be a really good place for analysis and commentary. Also, there's a PDF in the description below this video and every video that I upload. Every day I go through and update a thing called pivot points. There's some pivot points that last through the whole month. There are other pivot points that change each day. That's on the YouTube community tab. I do have a private Facebook group. I also have another program. And if you're not necessarily interested in that, but having some back and forth with me and you belong to Facebook, please feel free to send me an invitation to join that group. Not an awful lot of activity there. I pretty much just post whenever I upload a video. I do really go through the YouTube and Rumble comments. I don't get an awful lot of comments on my videos because I don't really state a lot of opinions. I really just kind of try to say, this is the positive, this is the negative. But I still get a lot of comments on Rumble. They keep doing these webinars or something through Fiverr. And there's all these self-proclaimed social media experts who just have all the answers. I didn't know there were so many of them. I do post on Rumble as well as YouTube. Here is the link. If you can't find me on YouTube, that can happen every once in a while, or on Rumble, go to the other platform if you're looking to view a video. Also, I have a program called the SPXInvesting Program. It's still free. It's probably going to be free. I was going to lock it down in August. It looks like I'm going to delay that a little bit due to some potential travel plans. There is a link below this video that will take you to the website or to a playlist of videos to learn more about the program. And this is a little bit different than it was a week ago. I was talking to some members and they're like, how come the weekly videos are publicly available? Why not give members first access to them? Yes. So not only the daily videos, but the weekly videos, they won't be available until Sunday evening US time. Members have access right as they're developed. As I record this, the daily video has already been uploaded. That won't be available until the market close on Monday, when it goes public on YouTube and Rumble. So it's free for right now. Check it out. There's additional videos and additional information that I post on the website that I don't share publicly. So check it out and see if that is of interest to you. And the daily video is the real foundation of the analysis that I do. This weekly video is just one of many videos that I do over the weekend. But really, it's the daily video. Everything ties into the analysis as we go through each day. Another YouTube channel that may be of interest to you is Schiff Capital. He's a money manager, Chris Schiff. He does a weekly video. And if you're a longer-term investor, you may find his videos to be of value to you. Also, another person who posts kind of sporadically right now is Bob Kindle. He also has a newsletter that's available. He does a pretty good job. He's been in the markets for a long, long time. And so you might find some interesting insight from him. Okay, let's go back and talk about the week. For the week, we were up 1.45%. And we had a solid up week last week. So we're looking a lot more positive right now. But this is the concern. Ever since we had that big downward move at the beginning of August, it was actually August 5th, we've been climbing back up, but we've been doing it on below average volume. Now, part of that can be explained away by saying, here we are in August, people are on vacation. Well, before that big decline, we were seeing pretty hefty volume. So we don't want to try to explain this away too much. When we're going down on heavy volume and up on below average volume, that is a negative divergence, but we ultimately have to follow price. Price is the ultimate indicator. All right, the technicals are positive now, and we've had two back-to-back up weeks. And so we're looking pretty good. In fact, one of our major indicators, the parabolic SAR weekly chart, it has now turned over positive. And then the big deal in this past week was Friday when Chairperson Powell spoke in Jackson Hole, Wyoming. And the market really liked that. But we didn't necessarily break out above Thursday's high. We had what's called an inside day, where the high matched Thursday and the low didn't go below that. The market was really more like a roller coaster for the first part. We finally went down and then we're able to come back up. And I'll show you the intraday chart of that. And they pretty much now have admitted that they're going to cut rates at the September meeting. Now the big debate is how much? 0.25%, 0.5%, and that's what the market's trying to figure out. We want to pay attention to the geopolitical events that are going on, not only in between Russia and Ukraine, but also in the Middle East. And then it seems to be a little bit more under control now, but this uncertainty about the presidential election in the US. And then if we get any more Fed speak where Chairperson Powell says something or one of the other members end up saying something as well. Now the big debate continues to be, are we going to go into a recession? Are we not? The market is anticipating that we're not going to go into a recession. We're going to be watching the employment situation report, especially when it's coming out at the beginning of September. That will be for August. And if it's weaker than expected, we might freak out like we had happen last time. If it comes in with good solid numbers, then the market will probably like that. But that's kind of the dividing line right now economically. If employment can stay strong, then the market thinks that we will avoid going into a recession. If the employment situation starts to fall apart, then the yield curves will come back and no longer be inverted. Usually about an average of 5 or 6 months after that is when a recession may start. And we don't know. There's all kinds of people that proclaim these things and think they know what's going to happen. We follow the charts, follow the evidence, and then just adjust things as needed. Our trend is still weakening. We're still dropping below the moving average, but the green line is on top. So it shows that we're in a positive trend. And we're seeing that on the daily charts, both in the short and intermediate term. And we're having that confirmed here on the weekly chart. But I'll show you all these charts as we go through this. So here's just some bullet points for the past week. The stock market did have a positive week. The S&P did pretty good. The NASDAQ and NASDAQ 100 did pretty good. No new all-time highs, but we've really bounced back from that decline that we saw earlier in the month. Buying activity was driven by this idea that the Fed is going to lower rates beginning in September. And now we're looking out even a little farther into the November meeting to say, okay, what's the market think is going to happen at that meeting? And this adjusts every day. Volume still remains below average, and that is a concern. We're going up. And even on the down day that we had on Thursday, that was still below average, but it picked up a little bit higher than it has been. And then the speech that Fed Chair Powell gave at Jackson Hole, it was considered dovish. That's when the market really likes it. It's more market friendly at that point. And basically, to quote what he said, the time has come for policy to adjust. He did say later on that he's a little bit concerned about the employment situation. Well, and the Fed's really going to be watching that. Then earlier in the week, we received the meeting minutes from the last FOMC meeting, and they actually considered cutting rates in July. They didn't do it, but they considered doing it. And they said at this meeting that a rate cut was plausible. So that's pretty dovish from the Fed as well. This was kind of interesting, though, and I actually did a video that's on the website about this. I did it right before it came out, and then I addressed it after this was released. There's a discrepancy between the non-farm payrolls that we get every month and this report because they use different sets of data to calculate this. There's a thing called the non-farm payrolls, and the problem with this is it only goes back to March 2024. So this is like way out of date. It didn't have that much of an impact on the market itself because the data is so old. It goes from April 2023 to March 2024. And there were some forecasts saying that the jobs may be about 1 million fewer than were expected. Well, we were actually not too far from that. There were 818,000 fewer jobs than what the markets had originally been told. Now, if this information was more up to date, the market would have really reacted to that. But since it goes way back to March, the market's like, this is old news. We trade on things looking forward here, not looking backwards. But this has created some concern that the labor market has been softening for longer than we thought that it was. I forgot to put than we thought there. Interest rates were down too. We're still coming down with the 10-year yield. We're at 3.81%, where a week ago we were at 3.89%. The dollar has also been declining, and both of these together do give support to stocks in this kind of an environment. All right, so for the week, the Dow was up 1.3%, and then we had the NASDAQ up 1.4%, and I have to turn on my pointer here, and I'm not going to start recording this again. The S&P was up 1.4%, and small caps had a pretty good week, but they're still not really breaking out at this point. I'll show you the chart later on. They were up 3.6%. This is a chart that I've been showing for well over a year now, just to keep an eye on things. This is CPI from 1966 to 1982, and we're still in this downward sloping blue area. Now, what happened last time, when you look at this historically, we really shot up with inflation, and that led to the mid to late 70s, where things were not doing very well at that time. We call it stagflation, where we have super high inflation, but really no economic growth. And then after that was when things started to get under control. Now, as I always say with this chart, we don't know if it's going to play out this way or not. It might play out like this. It might be even worse than this. But there could be some variation. History rarely repeats itself. And that's one of my complaints about trying to match up what happened before with what's happening now and shifting things forward or shifting things back, whatever you want to do with this, because it never does quite repeat. Now, there are patterns. Human beings tend to act the same. There are a lot of indicators that I use that are based on mathematical calculations that we find in nature, like Fibonacci numbers. And so, yeah, we want to know about these things, but we don't necessarily want to declare what we know is going to happen based on one chart that may play out the way we see it here, or it may be different. Okay. And then RenMat came out with this research. I've been showing this for a long time too. I update the 10-year yield every week. We're at 3.81%. We're below the 4.02%. When we get above that level, that's when it starts hurting corporate profits. We're below this, so that's why things are more positive, because it tends to help corporate profits over the long run. All right, and this hasn't been updated since the beginning of August here, where we did see a pickup in those folks that have been unemployed for going on starting their 7th month here. We'll get a new look at this chart when the next employment situation report comes out. Okay, looking at the earnings, and this is what justifies stock prices going up, whether it's Morgan Stanley or the consensus, the dark blue or the light blue. These are still going up into the future. And as long as they're going up, people are like, hey, I'm going to buy me some stocks. All right, and then this is kind of a convoluted chart here. And I don't like to have to do this. The bottom part, I have to blow up my browser to like 500% and then take a screenshot of this smaller area, because you can probably barely see the numbers in here on the video. So I try to break it out down below. And this July 16th, that's when we hit a top and we hit an all-time high with the S&P. We saw extreme breadth to the positive side. It was an upthrust at that point. And that's the green diamond that you see over here. And it suggests higher prices going forward. Strength tends to build on strength. And then they went back and looked at all the other times we saw a really strong breadth like this. And then what did it look like going forward? 1 month out, we were up 63.6% of the time. Not a great track record there. You go on a little bit farther, now you're up to 70%. 6 months out, 90% of the time you were higher. 12 months later, you were higher every time, according to the signals that we see on this chart. So this tends to be quite positive for the market going forward. Doesn't mean we're going to go straight up or that we're always going to go up, but the data does suggest that historically that is what happens. Okay, then the largest inflow to gold in 4 weeks. A lot of people are seeing gold breaking out. They're listening to some people that they've been harping on gold for decades now, and they're finally having their day in the sun as gold has been doing well. And so they see the price going up. They're listening to these gold folks. They're concerned maybe about what's going on in the world. They're possibly concerned about future inflation. And so we start seeing a lot of money going in. Now, the light blue, that's money going in kind of right now. The 4-week moving average is actually declining, but it's still well above zero as more people are putting money into gold funds right now. Global shipping rates. And I also deal with this in the intermarket analysis chart or video. I have a chart that I go through called the Baltic Dry Index. And this is something that we watch more as an inflation type of a thing. When the Baltic Dry Index goes up, that typically means it costs more to ship things. When it goes down, that tends to be more deflationary. Well, we have been really going up with global container shipping rates, and this is a 4-week rolling moving average, which it's like a moving average. And even though it's still kind of high, it has been coming down, but it was really going up. And then we compare it to PPI right here. That's the light blue line here. So this might be a little concerning with PPI not really climbing. The high shipping rates might also be a concern, but they are coming down right now. Okay, the Fed cutting cycles can be very supportive. We have to know of the context. Why are they cutting interest rates? That's the key right here. That's also the key to how gold is going to perform. This is before they cut rates, and then this is how things can perform after they start cutting rates. If the Fed comes in and cuts rates, kind of like things look right now, where the economy's doing okay, inflation's coming down, it will help things if we cut rates. So let's go ahead and do it. That's a positive backdrop. And so that may not have as much of an impact on gold because gold really goes up if we have a recession. The market is anticipating that we're not going to have a recession, and gold really underperforms at that point. Now, if the Fed comes in, something happens. Use your imagination that just tanks the economy and really throws things into a tailspin. That's a whole different context. And then the Fed may come in and cut rates because of that. Now that's more negative, and stock prices and gold may go higher where stocks end up going down, usually in that kind of a scenario. So we have to know the context with what we're talking about here. Then 2024 already the third largest year for policy rate cuts. Well, that's outside the US. Fed hasn't done that yet, but other central banks spread out throughout the globe, they've been cutting rates, 84 so far at the time this chart was created. And then this is implied equity allocation by non-bank investors globally. This is just showing, and I don't know how they get this. If you're not if you don't belong to bank or JP Morgan, how do they know what to ask you, or how do they know where the information is coming from? But this is just saying, and I've seen some other charts recently and talked about them where folks are saying, okay, the US is doing pretty good. Let's go into emerging markets. Let's go into Europe. Let's go into Japan. We're seeing more global investments going out right now, and this is above the average for the time right now. Okay, mutual fund cash allocations have fallen to an all-time low. That just means, usually when you belong to a mutual fund or even an ETF, you need a parking spot for that money before you deploy it into a mutual fund or into a hedge fund even. So it's sitting in a money market account. Well, it's just saying that there's not a lot of cash in these money market accounts. It's in the market. They've actually gone to buy. So we're looking at this exposure here with the dark blue. These are hedge funds, net leveraged, okay? And they're at 72%, where you look at the equity stock mutual funds, the cash is a percent of the assets. It's only 1.4%. So there's a lot of exposure right now. So if we really start tanking, now this is as of the end of June, so this data is late, but the hedge fund information is as of August 22nd, a little bit closer to now. If we really start going down, folks start bailing, this number is they're going to take money out of stocks and put it back into cash. And that could also have a real impact on the market. Okay, FactSet just had this one post. When companies are coming out with their earnings calls and they do this conference call, how many times are they citing election when they're citing, and they're comparing it back to 2020. That's the last time we had a presidential election. A lot more this time. And this is from June 15th to August 15th. So some of this could have carried over when things were rather uncertain what was going to be happening there. And they were mentioning it then in their earnings calls, where by this time back in 2020, both sides were set at that point. And then what are they talking about? Okay, election and policies. This is the different areas that companies are concerned about. Energy, carbon emissions, that's the whole green thing. and different regulations, the market really fears that, because anytime the government comes in and starts setting up rules, it's usually not advantageous to the business. And then it's really hard to see this. Inflation. Oh, the Inflation Reduction Act, which really does nothing but cause inflation. And tariffs and trade, that's also a concern. You can taxes, housing, healthcare, defense, and then immigration. And now you hear about immigration, illegal immigration. You can call it whatever you want, but it's illegal immigration that you may hear about a lot in the media, but they're not really talking about it so much at the corporate level. Okay, so here is the intraday chart going back to Monday, and we did start off pretty good. We had a good day on Monday. We were pretty much sideways, but a little bit higher going into the close on Tuesday. Wednesday, it looked like, okay, things are looking pretty good here. Then on Thursday, I closed like all the positions. I had 8 positions and they were all bullish. And I hit my profit target on 2 of them. We had profits on another 2. And then 4 of the 8 were break even because we started really going down. Now, I didn't know what was going to happen on Friday. I'm just looking at what's rolling out on Thursday. And when we broke below this dark blue line here and then below this line below it as well, I'm like, okay, this can't necessarily be good. And then we did bounce back up a little bit here, but we really closed down near the low and it looked like things were turning. But then what happened? During the night, before the market even opened on Friday, the futures were just chugging their way higher, enough to lead to a gap higher on Friday. This is when Chair Powell was speaking. Blah, 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 roller coaster, seasick. We went down all the way to this thing called the daily pivot. We finally got some stability in the market, and this looks more like a trend actually going up, and we closed near the high. But you notice that the high on Friday did not exceed the high on Thursday, nor did the low. That's why we call this an inside day. And some folks pick that out in technical analysis and go, ooh, ah, ooh, ah. The perma bears are going to just party over that one. So we'll have to see what they end up saying here. This is for the week, all the different indexes. Now, this is just for the 5 trading days, not Friday to Friday, just Monday through Friday. The NASDAQ 100 ended up being down with the NASDAQ barely being positive, where we had the small caps. And a lot of that gain was in Friday's session, followed by the mid caps, the NYSE, the Dow, and the S&P. But everything was up except for the NASDAQ 100. This is going back to the beginning of the year where the NASDAQ and NASDAQ 100 and the S&P are doing the best. All of the indexes are positive year to date now. The sectors. This is for the week where we saw money going out of the energy sector, but all of the other sectors were up. Real estate, they like this interest rate going down thing. We want discretionary to do better if we're positive on the market. That's been a real disappointing area in 2024. But all the other sectors ended up being positive on the week. Then we go over to the right-hand side here. This is on a scale of 0 to 100. The closer to 100, the better looking that sector. The utilities are still looking pretty good. Real estate's looking pretty good. They're in the 90s right now. Energy is now dropped to the lowest. It's way down at 15 with the current score. All right, here is looking at the 5 trading days for the different sectors. All of them were up except for communication, tech, and energy ended up being down. And then going back to the beginning of the year, and yes, these are going to be different than what you may see otherwise. I don't include the S&P 500 into this mix. I'm just looking at all of these different sectors individually. Where we have communication up, technology's up barely, and all of the other sectors are still down year to date. Okay, then the relative rotation graph. The top right corner, these are the things that are strongest, and this is a long green tail right here, showing that real estate has been improving. We're seeing some improvement here with discretionary, with healthcare. Those are defensive areas, not so much discretionary. It's more staples, XLP. And some of these are looking a little bit better. And then we have things like tech and utilities, which are dropping back a little bit now. We still have energy and materials and industrials. These are red. This is the most negative part of the market when you take the whole last year together. All right, and this is what it looks like with real estate looking good. Then we have some blue areas, which are positive here. And then the yellow areas are more neutral for the time being. And of course, the red, they are more negative currently. Then we look at the different indexes going back over the last year and comparing it with the S&P 500, where we have utilities still looking about the strongest, where the S&P, the NASDAQ, and S&P 100, they have been coming under pressure lately. The mid caps are still negative, but showing some improvement as they're going up. And we're seeing a little bit of improvement with the transports and the small caps and the Dow Jones Composite. So there's some rotation going on here as we're seeing more of the broad market participating in things. This is what it looks like here, with the utility still looking the best. Then we have transports, the composite, and small caps. Neutral would be the NASDAQ 100, the S&P 100, and the S&P 500, and the mid caps are still lagging behind, which, as I always point out, earlier in the year, this was the strongest area of the market. Now it's coming in at the weakest currently. Sentiment, just to give you an idea, this is a betting site called predictit.org. I don't actively participate in this. I just go and I look at this and go, oh, isn't that interesting? There's quite a media buzz going on right now, and that's showing up here with having Harris in first place and Trump. You'd think if Harris is as great as they said they were, she'd be a lot further ahead than Trump. But anyway, that's the way these things go. And believe it or not, you still have Biden on the list here, and DeSantis and Haley, and they've all dropped out of the race. Okay, looking at sentiment, we're still neutral. We're above 50, though, so we have more of a positive slant to things right now. To show you how they've changed, we came down and we were under 25. That's when we look at using this as a contrarian indicator, and it paid off. This was during the big decline in early August. We've been coming up, showing a real improvement, and we tend to go with this. Now we turn even a little bit more positive as we go above 50. Now, if we can stay above 50 and keep going up, that would keep us even more positive. If we drop back down to below 50 and start to decline, that would turn things more negative. So this is pretty volatile since this is based on emotions. The active asset managers did spark up a little bit here, but they're still not giving us really extreme reading. This is that same thing coming in at 74.68, just on a different chart. All right, looking at the VIX, which just spiked up and was well up into the mid 60s there when we had the big downtime. The VIX has really been coming down, even though on a weekly basis we did climb back up on the line chart as well as the bar chart. But we're back down into much lower levels with the VIX as the market has been going up. This is the seasonal chart. Seeing, are we going to stick to something like this? This decline that we saw near the beginning of August, that's not necessarily strange according to the VIX, and the VIX goes up, or the VIX goes down as stocks are going up. This is what historically has happened, and this could be a little bit of a concern, especially when we get into September and then into October. The VIX going up means stocks go down. Now, we may not stick to that. Something different may develop. But historically, September has been one of the worst months for stocks ever. October has been good at times, but yet the major crashes that we've had have also come in October. So just be aware of these things. And then we are going back down here with our long-term equity put call ratio. When this is going down, that is typically more positive for the market. We look at a ratio between the VIX and then a 3-month average of the VIX. When this is going down, that tends to also be positive for the market. The Ulcer Index, it really dropped off a cliff on the daily chart. We're still underneath the moving average here. It got quite high on the daily chart and just went boom, down. Well, this is not registering any real major fear on the weekly chart. This is the ratio between bears and bulls. When this goes up, people are bearish. When this goes down, people are bullish. And you can see all the gyrating that's been going on here. And we're coming in at a pretty high reading. This was after Thursday. We had a pretty significant down day on Thursday. So this, folks are jumping over. But then we had a pretty good up day on Friday. So now the folks will jump down and this ratio will end up going lower. That's the problem with doing things after they've already happened. And that's why I really harp on watching the daily videos. We tend to see things before they happen. Now, we don't know how things are actually going to play out, but I go through and I say, this is what to watch for. This is what we need to see. This is what I'm watching for this particular day. And it just prepares you. So instead of reacting and doing things on an emotional level, now you're using actual logic to do this based on evidence that you're seeing in the charts. Okay, then also, this is another sentiment gauge. When this black line is going down, that means the tech sector is outperforming cash. And that is currently what has resumed happening now. This is the latest reading from the American Association of Individual Investors. They are positive, but not once they get above 30, that's when they start to get extreme positive. In the meantime, we use this like we do the fear and greed index, where we just kind of go along with this. Now, this is you and me. We're individual investors here. If this gets up above 30, we start to get concerned, and looking at using this as a contrarian indicator, we really get concerned if we go above this 40 level with the purple line. That's when things start to look a little too toppy. And then we wait for confirmation with other charts to see if we're actually turning. Another thing we're keeping an eye on is the spread between risky and not as risky bonds. I've been going through this in every daily video. What I've been focusing on here is the next chart, which is an inverted version of the chart we just saw. The area that I'm really focusing on is the middle area here. When this is going up, that means fear is decreasing because this is inverted. So we want to see this continue to go up here to mean that it'll mean that fear is coming out of the bond market, and that is typically positive for the stock market as well. Okay, looking at the latest reading, and we're going to get the second estimate for GDP in the upcoming week. Right now, the latest reading here is that we're coming in at 2%, where the top and bottom ranges are about 2.5% to the upside and a little bit under 1% to the downside. But again, the takeaway from this is everything is positive at this point, because one part of the definition of a recession is you have negative GDP for 2 consecutive quarters. There's other things that we look at too, but this is what people really focus on. But right now, whether it's Goldman Sachs or these black diamonds here, we are looking positive and actually looking at going up into the future here. And so this is not necessarily suggesting we'll go into a recession. Now, the economic reports start to fall apart. The employment situation starts to fall apart. These numbers are going to change drastically, but right now they still look positive going forward. This is also showing that same thing. And the takeaway from this is all of these columns here are above zero. They're positive. Then looking at the latest reading of the Chicago Financial Conditions Index, we get nervous if we go above the black line. We're still well below that currently. So there's no concern according to this chart. This is what a lot of folks are really all flustered over, but we're not going to get another update until the next employment situation report comes out. This is the real time, which I don't know how you can call that real time when we're waiting for weeks to get this updated. And the person who actually invented this even said it may not be right this time, but it could be right too. It came in a little bit above this red line. The red line is at 0.5. The last reading came in at 0.53. You got the Perman bears dancing in the wings, just totally sure that everything is going to fall apart. You've got the creator of this thing saying maybe it's not correct this time, just like the person who discovered the yield curve inversion in the relation to recessions. They won a Nobel Prize or something for that. They came out about a year and a half ago, maybe 2 years ago, and said, it may not be right this time either, because we're in a totally different environment since the whole COVID lockdown. We've never seen things that we're seeing now. Okay, this is not really a concern. The smooth U.S. recession probabilities, we're still below the black line. We get nervous if we go up above the red line. And this also is only updated once a month. This is only updated once a quarter. This is the Brave Butters Kelly leading index, where it is declining, but we're not going to get another update of this until we get to the end of the third quarter. All right, then inflation now. We are going to get PCE and core PCE on Friday. So this is going to be adjusted. We had CPI come out recently here, and inflation has been ticking down since then. Fed Watch. Okay, this is the September 18th meeting. Right now, there's a 76% chance that the Fed is going to cut rates 0.25%. You notice that leaving them unchanged is not even on the table now. If you add up 76 and 24, that's 100% right there. So the market has said there's a 100% chance of a rate cut. We just don't know how much right now. There's still 24% that say that it's going to be 50 basis points. All right, and this is how this has changed. Getting more locked into this. Down a little bit here. If we see some economic reports that are weaker than expected between now and the time they make their decision, this may get bumped up. and we may look at a 0.5% rate cut. And remember, on August 5th, you had all these so-called experts coming in saying, we need 1.5 now and 1.5 at the next meeting. I mean, we need 3% cut off the Fed funds rate. Well, that kind of whole situation fixed itself in a couple of days because the financial media is just trying to draw on your emotions and have you react to that. Now, we also are looking out into November. The next meeting will be November 7th. And yeah, rates are going to be dropping from here. It's just a matter of what is the actual rate cut going to be. And this is how we look at the change. I don't pay as much of attention to this because there's still quite a bit of time between now and the time this meeting is actually going to happen. Okay, looking at the Fed balance sheet here, where again, you can only really see this with government charts as the balance sheet's going down, but the numbers going up. All right, then this is another way, a year-over-year basis, where we're actually coming down here and also coming down here when we look back a year ago. So this one actually makes a little sense. We want to keep an eye on this. We're still getting a low reading with the overnight repurchase agreements. If this really starts to tank or really starts to go up, then we're going to wonder, okay, what's going on here? What is something happening with the banks? So far, we're not really seeing any concerns. Okay, let's look at the breadth where we're looking pretty good here. We're seeing still a negative divergence on the daily charts where we've been going up with price and volume, but we haven't broken out on the daily chart where we have started to break out here on the weekly chart. So this is actually looking more positive, and that's better for the longer term picture. We're going up based on price and volume here. And we saw a real nice advance of the new highs this past week. That was enough to turn our 4-week back up and our 10-week back up as well. An internal measure here. And we're also looking pretty good on the daily chart with this. So we're looking good on the daily version and the weekly version here, which kind of confirm each other. And we're going up above zero with the advanced decline ratio. Accumulation distribution, we're above the moving average. We're also looking quite positive now, maybe a little too positive. We're getting kind of far away from the moving average on the daily chart, but this is still looking pretty solid here. And this is a smart money indicator. Then looking at our trend, the green line is above the red line. I know there's all kinds of lines out here, but if you can pick it out, because I've got a moving average, that shows that the trend is actually weakening, but it's a positive trend since the green line is above the red line. The Erin also tries to match up buyers and sellers. We're coming down, but we're still above zero. So this is still positive. Mass index, we are now getting a signal that's being generated on the daily version of this chart, which may suggest a reversal. And because we were going up, which caused that chart to show the trigger or the trigger to be signaled or the signal to be triggered, whatever. But this is not necessarily a perfect indicator. So we want to look at other charts to get some confirmation of that. Okay, here's the daily chart where we didn't come back and set an all-time high on Friday. In fact, we couldn't even get above Thursday's high. And you notice the last number of days were well below average here with volume. We're still positive, though, with the Keller market model across all time frames and all the different indexes. We're negative across the board with commodities and the dollar, where stocks and bonds are positive on different time frames. No change with the decision point scorecard. Everything is positive here. We're still well above the midpoint of the trend channel here. And if we really start to go up and set a new all-time high, eventually I will extend this chart, but there's been no need to now. This is rather positive. When we declined at the beginning of August, we came all the way down to this R1 level, and that ended up providing support. We've since bounced back up. We were able to get back above this R2 level, and we've had another week now above this level, and that's looking positive. Now, we haven't set an all-time high, but we're not all that far away from it either. Looking at a 50-period moving average, that's 50 weeks here, which equates to a 200-day moving average. Price is going up, and the red line's going up, and price is above the moving average, so that's positive. Then switching it around and using a moving average crossover with a 13-week versus a 50-week, both lines are going up. The blue line's above the red line, and price is above both. That's positive. We're getting a little extreme here, but this could also suggest good momentum with the McClellan oscillator. That's still looking pretty good. And the summation index based on price is going up as well as volume. So we're seeing confirmation there. Also, the Swenlin trading oscillator going up based on price. We actually ticked down a little bit here based on volume. And we saw that even in Friday's session on the daily chart, volume still ticked down. So it's just a little bit of a warning sign that we're watching. Bullish percent index above 50 and going up and not extreme. This is suggesting that there's a lot of point and figure buy signals being generated inside the S&P 500. That's positive. And here is the momentum. We're still negative here. It's going to take a while to shift things back over, but we are seeing a bit of an improvement. We're above zero based on price and volume with the PMO. And we're starting to get extreme here with the PMOs that are rising. We're also extreme on the daily chart. We're close to being extreme with the buy signals. And this is also showing the same thing on the daily chart. And we continue to go up with the PMOs that are above zero. And looking at the Bollinger Bands, we're above the midpoint and going up, but we're not outside of the upper Bollinger Band yet. So this is just plain positive. We are showing a little bit of improvement here with the slope oscillator here. This is our shortest term one. We're trying to turn back up here with the TSI, another short-term oscillator, but it hasn't crossed above its moving average yet. The intermediate term, MACD, PMO, and PPO, they're turning up, but they haven't crossed above their moving averages yet. The TRIX and KST are our longer-term oscillators, and these are still declining. It's going to take more to turn them up. Tick and money flow, another smart money indicator, looking rather positive on the daily chart, starting to turn up here on the weekly chart. So we're seeing confirmation of positive action here. The force index on the daily chart and here on the weekly chart are both positive. This is a concern. We're still going up with the Chaikin oscillator. We're actually starting to come down on the daily chart with the Chaikin oscillator. That's a little bit of a concern. The reason why I bring that up is when we were screaming down in early August, Chaikin oscillator actually started to turn up a little before price did. That was some smart money going in and buying as we were going down. So we're wondering, as we've been going up, are they selling into strength? We don't know. We just see it in that chart right now, and we'll just be watching that. And I'll be covering this in the daily videos. The money flow, even though it came down, it's still above 50. So this is positive. The rate of change is still positive since we had an up week compared to last week. And we're looking pretty solid here with the rate of change going back 50 weeks. The RSI is above 50 and going up based on 14 weeks. That's positive. The Stochk RSI is above the midpoint. That's positive. The special K oscillator is looking okay, but we still have not been able to cross above the moving average, where we're positive on the daily chart. We're above zero, even though we ticked down a little bit here with the ultimate oscillator, but this is still positive. Wins percent are starting to get extreme positive here. The vortex, positive on the daily chart, positive here on the weekly chart as well. The copy curve trying to turn back up, hasn't quite crossed above its moving average yet to turn positive, where it is positive on the daily chart. And this is just showing how we came really close down to the support level. We didn't quite get to it, and how we've been bouncing up since then. And looking at our different trend measurements here, the Heiken Ashi has open candles. That's positive. We're still red. That's negative, but we're pointing up with the Kagi chart. So it's negative with a positive bias. We're still positive here with the Renko chart, and we're turning back positive here with the three-line break. So we're seeing more confirmation of the positive trend. Looking at the ease of movement, we're above zero and continuing to go up. That is positive. We were up just enough to draw in a new X, but we don't have a signal generated here. But if you're positive on the market, seeing a new green X is a good thing for you. And then looking at our longer term, more momentum studies, the long term is starting to go back up. We're just about flat to still trying to go up here in the intermediate term, where we have been going up in the short term. Now, this is another thing that we don't know if this is legit or not until we look back on it. And by then it's too late. This is a 50-day cycle, which if you look back, sometimes it's marked the top, sometimes it marked the bottom, sometimes it meant nothing. Well, we had a new cycle start on August 19th. We apparently you could say, oh, we're topping out here. These cycles are starting. We're going to go down. And that could very well happen. But we're not going to know that until we can look back on this and see. That doesn't do us really any good. We need to be looking forward. We need to have foresight, not hindsight, when we're looking at these charts. But still, this is kind of interesting to look at nonetheless. All right, we have gone back to being neutral for the last 2 weeks with the Elder's Impulse system on the weekly chart of the S&P. And this is a big one. We're positive on the daily parabolic SAR chart. We've now switched back to positive here on the weekly chart. So they're now confirming each other. Then looking at just the indexes with no studies on them, getting close to the all-time high with the S&P, really not breaking out, but showing some improvement with the mid caps, not breaking out, but showing some improvement here with the small caps. And then looking at August, where we're up 60% of the time if you go from 2020 to 2024, with a return of 1.2%. But look at September, no positive months from 2020 to 2024, and we're down 5.7%. Now, is that going to be different this time? I don't know. Maybe it's time for things to change. But if you deal with things historically and looking at the charts that we look at seasonally as well, you might want to be a little bit concerned about September just coming right around the corner. Okay, now looking at the Dow, we're positive here. We're above both of the moving averages and all the lines are going up. The NASDAQ is also looking positive. It was able to bounce off its 50-day moving average on Friday and show some strength. NASDAQ 100 also bounced off its 50-day moving average and is looking pretty solid here. It almost came down to this 50-week moving average, and we were able to bounce up off of that. Here's another weekly look here at the NASDAQ 100, where we were looking ugly with this doji here at the top. We declined. Now we're showing more strength as we're going back up. Mid caps not breaking out yet, but still looking more positive above both of the moving averages, and the moving averages for the most part are going up. Small caps not breaking out to new highs yet, but still looking better, and they got most of their gain on Friday. The Wilshire, this is a daily chart, and I like to look at this in most of the videos that I do. We're looking pretty solid here, but not setting a new all-time high. The NYSE, another broad market measure that we look at, is setting an all-time high because we're seeing more strength across the broad market, not just in the NASDAQ 100 and the S&P 500. We're actually seeing the NYSE holding up quite well right now. In fact, it's now generating a new all-time high. All stocks looking pretty good. These are U.S. as well as foreign stocks together. And the biggest software companies not really breaking out, but still maintaining an uptrend here. The FANG index, it closed right on its 50-day moving average on the daily chart. Well, we've been able to close just a little bit above that now. So this is turning a little bit more positive. ARC, which just seems to be in a lot of trouble now. What was it? It was said that they sold something where their cost basis was way higher than what they sold it for. Some big name company. I don't follow it all that close, and I don't want to misspeak the name of the company. Looking at the banks, this is encouraging. The banks are holding up quite well here with the bank index. We're above 50 and going up. We're trying to turn back up here with the momentum. And this is also kind of a sentiment gauge here. If people are putting their money back into banks, that means they have confidence in those banks. Just like It's a Wonderful Life. If they don't have confidence in the bank, they're going to come and try to get it out. Okay, this is Dow theory, which really just shows the Dow and the transports. That's traditional Dow theory. I also include utilities here, but we're not back to the all-time high with the Dow. The transports have just been going sideways. We have been seeing some strength lately in the utilities, but they have pulled back from recent highs. Then looking at the CRB index, still in an uptrend, but below both of the moving averages now. We'll see if this can bounce back up and see some strength. Oil continues to be in the 70s now. We're watching this mainly for geopolitical reasons. If something really flares in the Middle East, you might see the price of oil really spike up. In the meantime, the market's really not paying attention to what's going on in that part of the world. We're just about ready to see a downtrend or a death cross here on the daily chart, but here we've already seen a death cross on the weekly chart. That's because the moving averages are closer to each other. So for some strange reason, this trend actually tends to change faster than on the daily chart. But we're seeing some weakness in the dollar right now, which has been helping stocks. Copper, a barometer of the economy, we're coming down right to the 200, I should say the 200-day moving average, even though this is a weekly chart. Isn't that interesting? But we want this to go up if we're more positive on the economy. If this continues to go down, that means we're more negative on the economy. Gold coming out and setting new highs this past week. Silver not really breaking out yet, but still looking positive. We're going up with the total bond ETF. This is bonds based on price. Monthly chart of stocks to bonds rolling over a little bit, but stocks still continue to outperform bonds. This is a daily chart of the yields as they've been dropping as of late. This is a weekly chart looking internationally with the US and UK rates being the highest, followed by German rates and then Japanese rates. Then some relative studies. We still have now gold in first place, stocks in second place. Oil has now dropped to third place. And we're going down a bit here with the dollars. It's been under weakness, but now for a large part of August, Bonds are finally positive on the year, where they had been negative going back to the beginning of 2024. Looking at a ratio between the NASDAQ 100 and the S&P 500, they both have been doing okay, but the NASDAQ 100 is starting to underperform. To be more positive on the market, we want to see this ratio continue to go up. Looking at the S&P 100, the biggest stocks that make up the S&P 500, we're still not showing a real breakout here, but it's still outperforming. Growth to value. We want to see growth really outperforming value for more positive. If the market is becoming more defensive, value would be outperforming growth. We still see where growth is outperforming, but not really breaking out right now. Gold to the S&P, not really doing all that much on the weekly chart. Gold to the dollar, it's not, well, I guess there's some strength in gold, but it's more has to do with the weakness in the dollar these days. And we're back, we started to go up here in the beginning of August. This ratio was starting to freak out, but we're back down here to the moving average, showing that bonds are underperforming stocks. Okay, then we look at low volatility stocks. These are more defensive compared to the S&P. When we freaked out at the beginning of August, this really went up. Now it's been starting to come back down. Discretionary to staples. We want discretionary to do better. It's not. It's actually underperforming staples. Discretionary tends to be more growth. This includes like Tesla, Amazon are in this area. Staples are toilet paper and toothpaste, things that people have to have no matter what's going on in the economy. In a good growth economy, we want to see discretionary outperforming staples. Energy is really underperforming the tech sector. Also look at a ratio of that here. And then this is small caps to the tech sector. We were starting to see small caps come into favor. Well, they kind of dropped back down below the moving average. They're doing okay, and they were up in Friday's session. But overall, the small caps continue to underperform tech. And looking at some long-term cycles, there's one thing I want to point out here on the next chart. We're still looking positive here with the NYSE breadth thrust. Now, the next chart is called the ZWAG NYSE breadth thrust. And there was a post on Isabel Net, and there was also some posts on Twitter saying, we've just had a new ZWAG NYSE breadth thrust. Well, the definition of that, we have to come down and hit this 0.4 or below level, like we did back on April 15th. We didn't do that. We did see a thrust up here where we went above 0.615, and that's what a lot of folks were picking up on without realizing we need to get to a really negative point and then immediately, boom, go to a really positive point. So no, according to this chart, we did not get a ZWAG NYSE breadth thrust. But it doesn't necessarily, and you have 10 days to go from the bottom up to the top, 10 trading days. But you shouldn't throw this out because anytime we get a high reading with this indicator, that is positive in and of itself. Look at other times when we had a high reading. Yeah, it kind of marked a little bit of a top here, but other times it meant good things. We're still working off of the last ZWAG NYSE breadth thrust, which was triggered back in October, and these last for a year. This one earlier in 2023, this has fallen off the books. I just keep it on here because it looks so darn good. Okay, and these are the stats looking out 1, 3, 6 months into the future or 12 months, and what happens after a ZWAG breadth thrust has been triggered. Here's a weekly chart of the S&P. We're still well above this trend line going back to the 1987 crash. This is that same chart, just showing it a little more up close here. We're still on a full-on buy signal with the Zohorchak method. Looking at the NASDAQ 100 weekly chart, we're back above this trend line and continuing to go up. And then looking at the new highs, new lows, and this is a 50-period moving average. I show a daily chart on the daily video. If this can turn and keep going up, that would be even more positive for the broad market because that means it's averaged out over a period of time instead of just a daily score. Then we also look at a 50-period new highs, new lows of the S&P. This going back up is more positive, but we want to see this really continue to go up, not just chop around the way it's been doing the last few months. We look at a ratio between the NASDAQ 100 and the Dow. The perma bears, where I got the idea for this chart from, were so sure we were going to come up right to this level that we hit in 2000 and then in late 2021, and everything was going to fall apart. Well, we ended up breaking above that. We came down, but now we're still above this level. So I'm not quite sure what they're thinking about this. There's another one, the Qs to the small caps, the NASDAQ 100 of the small caps. We're right about on this blue line. They thought we were going to come up to this blue line and fall apart. So far, that hasn't happened. We look at a cumulative measure of the NASDAQ new highs minus the new lows. We're ever so slightly starting to go back up. This would be more positive, where we had been declining for literally years. Down on the bottom is an example of just the daily new highs versus new lows. If there's more new highs, it's positive. If there's more new lows, it's negative. We look at another ratio, semiconductors, a huge part of the tech sector compared to the Dow, not really falling apart, but still a little bit below this blue line here. So we just want to keep an eye on these things. We're also keeping an eye on the 3-month yield, because if you look back in 2007, everything was humming along, looking all good. And then this thing just went in the toilet. And that's when we went into the great financial crisis. So when we started to come down, when the market was starting to freak out about things, that was causing us some concern. Now we have fallen a little bit here. Is this coming down now because the Fed might cut rates, or because the economy is falling off a cliff? We don't know at this point. We just watch this chart and make note of it. Seasonality, we're kind of bucking the trend here. This is put out by Dan Bird, showing that August tends to be quite a good month when we have an election year going back to 1950. It's been pretty choppy right now. August tends to perform well. The thing to be aware of is look at September. Also, August on a global basis tends to not do all that well. And September doesn't do all that well, but a little bit better than August. Then we take June, July, and August together. They both tend to perform well during an election year. Here's another look during an election year of how these tend to perform in the summer. We're done with the first half of August, and that tends to be rather anemic. The second half of August is where we see most of the strength historically. And then this is how do stocks do when the current president doesn't run for re-election. They still do pretty well going forward. And this is a little bit outdated now, but and the only thing I can think of, there was Truman who didn't run, and there was Johnson in '68 who didn't run when they could have run for re-election before there was an amendment limiting them to 2 terms. Those are the only ones I can think of. And I'm a history teacher, but don't quote me on if those are the only 2 presidents or not that haven't run for re-election. I mean, there's been presidents that have only been in 1 term and lost in the re-election. I mean, they bowed out before they were able to do their second term. This is put out by Stock Traders Almanac. This is how we've been bouncing around in August. Now we're kind of not too far from these current levels. And then these are all the election years, which tends to be more positive, but we're kind of in this open field election years because the Democratic nominee has dropped out and now there's somebody else. And then we don't know if the Republican nominee is going to go to prison or not. So this is kind of about as open as it can get at this point. And this tends to not bode well because of the uncertainty that's involved. And then this is just for historical purposes where we have a lot of inflation. This was put out by Stock Traders Almanac. This goes all the way back. And I'm sure you all remember 1913, 1914. That's when World War I started. Go through World War II. Basically, the takeaway from this, just because CPI goes up, stocks can still go up too. But if you want to pause this and look at it, you want to talk to me about any of these historical things that have gone on, 20th century is kind of one of my more areas of interest. That and the American Revolution. Then going back for the month of August, and the S&P is up 11 out of 18 times, and we're down 7 out of 18 times with a return of 1.3%. So thank you. I hope you are having a wonderful weekend, and I'll be preparing some more videos after this. So have a great weekend. I hope this video helped you, and I will talk to you in the next video.